Hello everyone, good day and welcome back to my channel. My name is Juliet, and in today's video we're going to be talking about different investment portfolio, how you can diversify your investment portfolio in order to maximize profits and returns and minimize risks. If you're new to this channel, you're welcome. We discuss personal development, career opportunities, business opportunities, financial and investment opportunities. So if you're interested in content like this, subscribe for important information in this channel. Looking at this topic explains itself. Like literally, diversification simply means not putting all your eggs in one basket. So if you're new to investment, you're trying to know what to invest in, this is the best video you're going to come across today. So basically, when you're trying to invest, it is very advisable for you not put all your capital in one particular type of asset, particular type of investment, because if that's in crash, your investment literally turns to zero. You will not compare putting all your capital into one particular kind of asset and somebody that diversifies, someone that puts into varying assets or different kind of investments. Definitely, if the person loses one, the person is tend to gain in another sector. We are going to be looking at different assets you can invest in. We have the stocks, for instance. So investing in stocks is just like buying parts of companies. For instance, in Nigeria this year we had lots of banks selling shares to the public. If you're able to purchase shares or stocks from a company, it means you're a part holder of that company. And this is particularly a very risky investment, because if that company crashes, your investment literally turns to zero. In terms of purchasing stocks, you can purchase from different sectors. Even advisable, if you're even purchasing only stocks, you should purchase in different sectors. For instance, you can purchase in the technology industry, the banking and finance, the healthcare, whatever sector you're interested in. And it's not even advisable because you feel one sector is booming right now for you to invest all your capital in that sector, because you don't know what will happen. Maybe you're buying stocks in the hope of earning dividend or selling in a few years to come. But what if next year or upper year that company is no longer viable and it's maybe forecloses or it shuts down? Your investment literally turns to zero. So it's very important, even when buying stocks, try to diversify your investment. You can buy part in some sectors and buy in another sector, because there are some hidden mines that they might not be viable now, but in the coming time, maybe in a year or 2 years time, they would be a lot more viable than you can even predict. So that is one. Then we have the bonds. Investing in bonds is very crucial because these are very low risk investments. For instance, the government bonds or treasury bills, you know that your money is definitely going to come back to you. It's just that they have lower returns. That's why it's very important to diversify. Yes, you can buy shares, but it's also very important to invest in some bonds. There are very good bonds that are sold in the banks, that are sold in the treasury markets, that you can invest for yourself. And these are investments you can literally do with any amount of money you have. Do you understand? You mustn't wait till you have millions before you start investing. You can start investing the little you have in these assets. The next is real estate. Real estate is basically for people that has substantial capital down. So you can gain interest. You can just buy a piece of property. It mustn't be a luxurious or big property. You can just buy a piece of property, or you can even take a mortgage to invest in a property, and then you can earn income through rents, through leases. There are several ways you can earn money from real estate. And one thing with real estate is a kind of investment that always appreciates in value, whether there's inflation or not. No matter what is happening, it appreciates in value. So investing in real estate is a very, very good way to start investing or to boost up your already existing investments. The next is commodities. You can buy commodities such as gold, silver, agricultural products. In terms of agricultural products, there's depreciation. Definitely, if you're buying, investing in agricultural products, maybe you're investing when there's surplus for you to resell when there is little. That's very good, but you have to make sure that there'll be demand for such products when it is scarce, so you can sell and make back your returns And then commodities like silver, commodities like gold, the value always appreciates. There's no time you can look for gold or diamond that the value is depreciation. So long as you have the original, whenever you want to sell it, it's very important. Most people that are into the entertainment industry, they spend a lot of money on this kind of thing. I'd be like, oh, are they not just wasting their money? They are literally investing because they can resell it even in 10 years time, 2 years time at a very higher value than what they purchased it. So commodities is another way also to invest your capital. Then we have some alternate investments such as venture capital, crypto. Investments such as cryptocurrency is very, very risky. The market is very volatile, like it changes rapidly. So investing in crypto is advisable for people that have studied the market and they are very certain that they're going to make profit. Of course, there's no investment that you would make only profit. Yes, you would make some losses, but it's very important that your returns exceed your losses. So if you look at the assets of investment, you can basically categorize your investment into different kind of investments you want to go into, different kind of assets you want to purchase, what you feel you would make more returns and what is less riskier for you. Another class that you can also diversify your investments is based on geography. So for instance, now you're based in a particular state. Let me use Nigeria for example. You're based in Enugu and you're trying to invest in real estate or you're trying to invest in stocks and you're buying from only companies located at Enugu. What if something happens to that geographical location? What if there's an earthquake, or what if there's a tsunami, or what if there's terrorist attack or something that can affect investments in that particular region? That's why it's very, very important to invest in different regions. You can diversify your investment based on regions, you can diversify based on state, based on countries, based on nations. It's just depending on you. But that's one advisable thing to do. Another one we have is diversification based on investment style. You can do growth versus value. There are some companies that grow rapidly. For instance, now if you're looking to maybe sell quickly, sell your investment quickly, you can go for growth. There are some sectors that grow rapidly, such as the information technology sector, the automobile sector. They grow very rapidly, they have a very high chance of growth. So you can decide to invest in such companies because of growth. You can decide to invest based on value. You can look into the market to predict the market. You can look into the market and invest in undervalued stocks. There are some stocks that maybe they're undervalued, but you're sure that within a year, within 2 years, they are going to rise. The value of such stocks is going to rise a lot. So you can also use that to diversify your investment portfolio. You can also diversify based on dividend and non-dividend stocks. For instance, now dividend stocks, they provide income to their owners. If you purchase stocks that are dividend based, you're going to be earning income with time. While non-dividend stocks, you only wait for it to grow and then you can sell to somebody else. So you can diversify your investment based on that, so that you will not just put your money in non-dividend and you're waiting for such stocks to grow before reselling. You can also put in dividend stocks that allows you earn income after a particular time. Also, you can classify your diversification based on their risk level. For instance, there are low risk level investments and their high risk level investments. This is what we discuss in the areas of bonds and the areas of stocks and the areas of cryptocurrencies and real estate. So you can literally diversify. For instance, now you can see bonds is low risk, stocks is high risk, real estate is low risk, and then crypto is high risk. So you can diversify your investment based on their risk level. So that is also accepted. And there are tools that also help you calculate the risk ratio, calculate how your investments, and even automate your investments for you. So if you're interested, you can just do your own research tools that can assist you monitor your investment, that can assist you automate your investment, that can also help you grow and pick the right investment. There are also apps and tools that I use that can help you purchase invest. For instance, if you're interested in purchasing real estate, you know the value is high right now and you don't have the money, but you're interested of being an investor in real estate. There are actually tools and applications that can assist you invest whatever little money you have into such companies, and in that way you can start building and start growing your investment until you have enough to invest as much as you'd like to. So we've come to the end of today's video. I hope you enjoyed it. I hope you learned something from the video. If you have any questions or any contribution, you can just drop it in the comment section. Thank you for watching, and I'll see you in my next video.